China's strategic crude stockpile, a buffer against sanctions and market volatility. China's rapid accumulation of crude oil stocks in 2025 is proving to be a strategic asset, especially as global oil markets face renewed disruptions due to U.S. sanctions on Russia's major oil producers. With a substantial buffer of strategic and commercial reserves, China is in a unique position to weather the storm. As the largest buyer of Russian crude, China's imports are unlikely to be halted, but its stockpiles are playing a crucial role in stabilizing oil prices. Despite concerns about an impending surplus, China's reserves have provided a floor for oil prices, even amidst trade wars and economic uncertainties. Analysts highlight that China's stockpiling efforts could offset short-term supply disruptions caused by U.S. sanctions on Rosneft and Lukoil, the two largest Russian oil producers. Kelly Xu, a commodity strategist, emphasizes the significance of China's strategic petroleum reserve and commercial stocks in mitigating supply chain issues. In the first 9 months of 2025, China's average crude oil imports increased by 2.6% year-over-year, despite sluggish fuel demand and predictions of peaking gasoline and diesel demand. This stockpiling behavior has supported international oil prices, pushing them into the $60 to $70 per barrel range, despite challenges from OPEC Plus and non-OPEC Plus exporters. China's approach to inventory management is distinct from the US, as it doesn't report inventories directly. Instead, analysts monitor overall supply, domestic production, imports, and refinery processing rates to estimate crude oil reserves. The key driver behind China's increased imports is stockpiling, not a significant rebound in demand, according to industry experts. From March onwards, China's stockpiling rate has been impressive, reaching nearly 1 million barrels per day, as noted by Frederick Lasserre at the APEC 2025 conference. This trend is expected to continue into 2026, as China aims to maintain its strategic and commercial reserves. Toril Bassoni, from the IEA, suggests that oil companies are now mandated to increase stocks at their commercial facilities, positioning private firms as long-term strategic storage partners for the government. This development further emphasizes China's proactive approach to energy security. The U.S. Energy Information Administration, EIA, supports this view, estimating that China's crude oil inventories increased by approximately 900,000 barrels per day between January and August 2025, essentially acting as a demand source by removing barrels from global markets. As U.S. sanctions on Russian oil firms create another major disruption, China's stockpiling strategy could prevent imminent spikes in oil prices, allowing traders and refiners to assess the sanctions' impact. However, Chinese state-owned oil giants have temporarily suspended Russian oil purchases, while independent refiners are expected to continue seeking Russian crude, albeit with caution. The massive Chinese crude oil stockpiles are poised to mitigate short-term supply shocks and cap oil price gains, even if sanctions are implemented on November 21, 2025, as planned. This strategic approach ensures China's energy security and influences global oil market dynamics.